Something absolutely bizarre is happening in the silver market that defies all logic and exposes a crisis that could send prices to the moon. Silver has crashed 40% from its peak above $121 down to $77.62. Yet physical metal is becoming harder and harder to find. Dealers are paying premiums of $8 to $10 over spot prices for inventory. Delivery times on silver coins and bars have extended from days to weeks or even months. Industrial users are scrambling to secure supply for manufacturing operations. This disconnect between falling paper prices and tightening physical availability is the exact pattern we saw before silver exploded from $18 to $50 in 2011, and before it surged from the $12 to $30 in 2020. The Silver Institute just confirmed that the market is in its sixth consecutive year of supply deficits, with demand exceeding mine production by over 80 million ounces annually. Meanwhile, AI data centers, electric vehicles, and 5G infrastructure are consuming silver at rates never seen before. In the next several minutes, I'm going to show you exactly why this shortage is intensifying, which industries are driving the crisis, and why this could be your last chance to buy physical silver before availability disappears completely. Welcome back to the channel, and if you want to understand one of the most explosive investment opportunities developing right now, you absolutely need to subscribe, because we're covering a market dislocation that could make early investors extremely wealthy. Today is February 13th, 2026, and we need to talk about the growing disconnect between silver's paper price and physical market reality, because this gap is telling us something critically important about where prices are headed. Let me start by laying out the evidence that a genuine physical silver shortage is developing, because I'm not interested in speculation or hype. I'm interested in documented facts that you can verify yourself. The most direct evidence comes from the premium structure in the retail physical silver market. When you go to buy silver coins or bars from dealers, you don't pay the spot price you see quoted on financial websites. You pay the spot price plus a premium that covers the dealer's costs, profit margin, and reflects supply-demand conditions in the physical market. Under normal market conditions, premiums on popular silver coins like American Silver Eagles typically run about $2 to $3 over spot price. For silver bars, premiums might be $1 to $2 per ounce. But right now, despite silver's spot price falling to $77.62, premiums have actually increased rather than decreased. Major dealers are charging $6 to $8 or even $10 over spot for silver eagles. Generic silver rounds are commanding $4 to $6 premiums. Even large bars that usually have minimal premiums are seeing $3 to $5 markups. Think about what this means. The paper price of silver has crashed 40% from its peak, yet the actual price you pay to take physical delivery has barely fallen at all. If spot silver is at $77.62 and you're paying an $8 premium, you're actually buying at $85.62 per ounce. When silver was at $121 with a $3 premium, the all-in cost was $124. So despite a 36% crash in the spot price, the actual cost to acquire physical metal has only declined about 31%. This premium expansion is a clear signal that physical supply is tight. The second piece of evidence comes from delivery times. Go to any major online precious metals dealer right now and check availability on popular silver products. And what you'll find is that many items show out of stock or pre-sale, ships in 3-4 weeks, or similar language, indicating that they don't have inventory on hand. Dealers who do show items as available often have shipping times of 7 to 14 business days, rather than the 1 to 3 days that was standard in previous years. I've spoken with several dealers who tell me that they're having difficulty sourcing inventory from their wholesale suppliers. The major mints like the US Mint, Royal Canadian Mint, and Perth Mint are running at full capacity, but still cannot keep up with demand. Wait times for bulk silver bars from refiners have extended from 2 and 3 weeks to 6 to 8 weeks or longer. This isn't a short-term supply chain disruption. This is a fundamental mismatch between available supply and robust demand. The third evidence point comes from the behavior of industrial silver users. Manufacturing companies that use silver in electronics, solar panels, automotive components, and other applications are increasingly moving to secure long-term supply contracts rather than buying on the spot market. They're willing to pay premiums and lock in prices months or even years in advance because they're concerned about availability. When you see industrial users behaving this way, it tells you they're seeing tightness in the market that worries them. COMEX warehouse inventory data provides additional confirmation. The amount of silver registered for delivery, meaning it's available to satisfy futures contract delivery requests, has been declining as a percentage of total warehouse stocks. There's still silver in the warehouses, but an increasing amount is in the eligible category rather than registered, meaning it's being held for specific owners and isn't available for general delivery. This shrinking delivery pool is concerning because it suggests that when futures contract holders actually want physical delivery, there may not be enough metal available. London silver inventories, which represent the global hub for professional silver trading, have also shown signs of stress. While exact inventory figures aren't published daily like COMEX data, industry insiders report that available silver for immediate delivery in London has tightened considerably. The backwardation that occasionally appears in silver futures, where near-term contracts trade at higher prices than deferred contracts, is a technical signal of physical tightness. What makes this shortage particularly interesting is that it's occurring despite a major crash in the paper price. Normally, when prices fall 40%, you would expect demand to weaken and supply to become more abundant. Now let me take you deep into the specific industrial sectors that are driving unprecedented silver demand and creating the supply crisis we're witnessing. Understanding these demand drivers is crucial because they represent multi-year structural trends that aren't going away regardless of short-term price volatility. This isn't cyclical demand that will decline in a recession. This is secular demand tied to technological transformation of the global economy. Let's start with artificial intelligence infrastructure, which is consuming silver at rates that didn't exist just 2 years ago. Every AI data center requires massive amounts of silver in electrical contacts, circuit boards, server components, power distribution systems, and cooling infrastructure. But here's what most people don't understand. AI servers use significantly more silver than traditional servers because they have higher power requirements, more sophisticated processors, additional memory modules, and more extensive networking equipment. A typical enterprise server might contain 20 to 30 grams of silver. An AI training server can contain 50 to 80 grams, or even more depending on a configuration. When you're building data centers with tens of thousands of these servers, the silver consumption adds up incredibly fast. And the AI buildout is just beginning. Companies like Microsoft, Google, Amazon, Meta, and countless others are investing hundreds of billions of dollars into AI infrastructure over the next several years. This represents demand for hundreds of millions of ounces of silver that will be locked into long-lived assets. Electric vehicle production is the second major demand driver creating the shortage. Each electric vehicle uses 2 to 3 times as much silver as a traditional internal combustion engine vehicle. The difference comes from battery management systems that require extensive silver circuitry. Electric motors with silver bearings and contacts, power electronics for managing high voltage systems, charging systems, and more sophisticated infotainment and driver assistance electronics. Global electric vehicle sales are projected to exceed 20 million units in 2026, up from just a few million annually 5 years ago. If each EV uses an additional 25 to 40 grams of silver compared to traditional vehicles, that's 500 to 800 metric tons of incremental silver demand just from the EV transition. And this number will only grow as EV adoption accelerates. Many countries have mandated phase-outs of internal combustion engines by 2030 or 2035, meaning the EV transition is locked in regardless of short-term economic conditions. G, telecommunications infrastructure, represents the third major silver demand pillar. Every 5G base station requires silver for antenna arrays, signal processing equipment, power amplifiers, and network electronics. The shift from 4G to 5G requires denser networks with more base stations covering smaller areas because 5G signals don't travel as far. This means that the global 5G buildout requires many more cell towers and base stations than previous generations, each one consuming silver. China, which leads the world in 5G deployment, has already installed over 3 million 5G base stations and plans to expand that number significantly. India is in the early stages of 5G rollout with ambitious deployment targets. The United States, Europe, Japan, and other developed markets are also investing heavily. The total silver consumption from global 5G infrastructure over the next 5 to 10 years will reach into the hundreds of millions of ounces. Solar panel manufacturing continues to be a significant silver consumer despite efforts to reduce silver content per panel through thrifting technologies. Each solar panel contains silver paste on its photovoltaic cells that's crucial for conducting electricity efficiently. While newer panel designs use somewhat less silver than older models, the overall growth in solar panel production more than offsets these efficiency gains. Global solar panel production exceeded 500 gigawatts in 2025, and projections call for continued rapid growth as countries pursue renewable energy targets and as solar becomes cost competitive with fossil fuels in more markets. Even if silver content per panel declines by 10% or 20%, if panel production grows by 30% or 40%, total silver demand still increases substantially. Electronics manufacturing more broadly continues consuming enormous quantities of silver in everything from smartphones to computers to appliances to industrial equipment. Silver is used in switches, contacts, circuit boards, and countless other components because it's the best electrical conductor of all metals. While individual devices might use small amounts, when you're producing billions of units annually, small amounts add up to major consumption. Medical applications represent another growing silver demand sector. Silver has natural antibacterial properties that make it valuable in medical devices, wound dressings, surgical instruments, and hospital equipment. As healthcare spending increases globally, and as concerns about antibiotic-resistant bacteria grow, silver usage in medical applications continues expanding. Now let's examine why silver supply cannot respond to this surging industrial demand, because this is where the shortage becomes not just a short-term problem, but a structural crisis that could persist for years. The fundamental issue is that silver supply is highly inelastic, meaning it doesn't increase significantly even when prices rise substantially. This is completely different from most commodities and creates the potential for explosive price moves. Let me explain the unique characteristics of silver mining that create this supply inelasticity. Approximately 70% of global silver production comes as a byproduct of mining other metals, primarily copper, zinc, and lead. This means that most silver isn't mined for its own sake. It's produced incidentally, while mining companies are primarily targeting base metals. The decision about whether to open a new mine or expand production is based mainly on copper, zinc, or lead economics, not silver prices. Think about what this means in practical terms. Even if silver prices double or triple, it won't necessarily trigger a massive increase in silver production because the mining companies are making their investment decisions based on other metals. A copper mining company might be producing 10 million pounds of copper per year, plus 500,000 ounces of silver as a byproduct. If silver prices triple, they're not going to significantly expand their operation because copper is still the primary revenue driver. The silver is just bonus revenue, not the core business. Primary silver mines, where silver is the main product, account for only about 30% of global production. These mines are more responsive to silver prices, but there are significant constraints on how quickly they can expand. Mining is an extremely capital-intensive industry with long lead times. From initial exploration to discovering a deposit, to proving up reserves through drilling, to obtaining permits and environmental approvals, to raising capital, to constructing the mine and processing facilities, the entire process typically takes 7 to 10 years or longer. This means that even if silver prices at current levels or higher make many new silver projects economically viable, we won't see material new supply from those projects until the early to mid-2030s at the earliest. In the meantime, we're stuck with essentially the current production profile with only modest annual increases. The Silver Institute's latest projections call for global silver mine production to increase by just 1% in 2026 to approximately 820 million ounces. 1%. Despite silver prices having increased from $20 to $77 over the past year, an increase of nearly 300%, mine supply is growing at 1%. This perfectly illustrates the inelastic nature of silver supply. Recycling provides some additional silver supply, but this source is also constrained. Most silver used in industrial applications gets dispersed in tiny quantities across millions or billions of products. The silver in a smartphone circuit board might be worth $2 or $3. The economics of collecting used phones, disassembling them, and recovering that tiny amount of silver are challenging. While large-scale electronics recycling operations do exist and recover some silver, the recovery rates are far below 100%. Silver used in jewelry and silverware has higher recycling rates because the silver content is more concentrated and valuable. When silver prices spike, people sell their old jewelry and family silverware, which provides recycled supply. But this source of supply is self-limiting. Once people have sold their discretionary silver items, there's no more to sell until new jewelry is produced and aged. Photography was historically a major source of recycled silver because film and photographic paper contained silver halides. But the digital photography revolution has essentially eliminated this recycling stream. The silver that used to flow back from photo processing labs no longer exists because film photography has largely disappeared. Geopolitical factors add another layer of supply constraints. Major silver-producing countries include Mexico, Peru, China, Russia, Chile, and Poland. Political instability, resource nationalism, environmental activism, and permitting challenges can all disrupt production or prevent new mines from opening. Mexico, the world's largest silver producer, has become increasingly difficult for mining companies to operate in due to security concerns and community opposition to mining projects. Environmental regulations continue tightening globally, which makes new mine development more expensive and time-consuming. Processing silver ore, especially from polymetallic deposits, generates waste products that must be managed carefully. The cost of meeting modern environmental standards adds significantly to project economics and timelines. Infrastructure constraints in many silver-producing regions limit expansion possibilities. Mines in remote areas of Peru or northern Chile may lack adequate road access, power supply, water resources, or workforce housing. So, after understanding that physical silver is becoming scarce despite falling paper prices, seeing how industrial demand is surging from AI, EVs, and 5G, and recognizing that supply cannot respond due to fundamental structural constraints, the critical question is, how should you position yourself to profit from this developing crisis? Let me give you a comprehensive strategy for silver investing in the current environment. First, let's address timing, because many investors are paralyzed by the fear of buying at the wrong time. Silver has crashed 40% from its peak, and the natural instinct is to wait for an even better price. This is a mistake. The physical shortage is developing right now. Premiums are elevated right now. Delivery times are extending right now. Every week, you wait is a week, where physical metal becomes scarcer and more expensive to acquire. The smart money doesn't try to pick the exact bottom. They recognize value when they see it and act decisively. At current spot prices around $70.62, silver is trading well below most analysts' fair value estimates. Bank of America puts silver's fair value at $60 to $70, which means current prices are at the high end or slightly above fair value by their calculation. But UBS predicts silver returning to $100 within a month. The Silver Institute's supply deficit projections suggest much higher long-term prices. When you have this kind of divergence between current prices and fundamental value with a developing physical shortage, the risk-reward strongly favors buyers. Your first action should be to establish or significantly increase your physical silver position with a target of 5% to 15% of your investable assets allocated to physical silver specifically, separate from any gold holdings. This is a meaningful allocation that will make a real difference to your wealth if silver performs as the fundamentals suggest, but it's not so large that volatility will keep you awake at night. Product selection matters more in silver than gold because premiums vary widely. American Silver Eagles are the most liquid and recognizable but carry the highest premiums, currently $6 to $8 over spot. If liquidity and ease of resale are your priorities, the premium is justified. Canadian silver maple leafs offer similar quality and recognition with slightly lower premiums, typically $4 to $6 over spot. Generic silver rounds from private mints carry lower premiums of $3 to $5 over spot and provide more ounces for your dollar, though they may be slightly harder to sell. Silver bars offer the lowest premiums for larger investors. A 100-ounce bar might carry a premium of just $2 to $3 per ounce over spot, giving you maximum metal for your money. The trade-off is lower divisibility and potentially longer selling times compared to coins. A balanced approach might be 60% bars for core holdings and 40% coins for liquidity. Buy from reputable dealers with established track records. In the United States, major dealers include APMEX, JM Bullion, SD Bullion, and Money Metals Exchange. Check prices across multiple dealers because premiums vary. Be cautious about deals that seem too good to be true, as counterfeit silver products do exist, especially from unknown sellers on platforms like eBay or Amazon. Storage is critical for physical silver. Unlike gold, silver is bulky relative to its value. $100,000 in gold is about 20 ounces that fits in your pocket. $100,000 in silver is about 1,300 ounces weighing over 80 pounds. For smaller holdings under $10,000 to $20,000, home storage in a good quality safe bolted to the structure is reasonable. For larger positions, professional vault storage becomes necessary. Dollar cost averaging is the optimal accumulation strategy. Rather than deploying all your capital at once, spread purchases over several months. This provides protection against short-term volatility and ensures you don't buy everything at a local peak. Commit to buying a fixed dollar amount of silver monthly regardless of price. If prices fall, you accumulate more ounces. If prices rise, you benefit from earlier purchases. Consider the industrial shortage angle for additional conviction. This isn't just a monetary or investment demand story. Real companies making real products need physical silver for manufacturing. When Samsung needs silver for smartphones, when Tesla needs silver for EVs, when data centers need silver for AI servers, they will pay whatever it takes to secure supply. This industrial bid provides a floor under prices that pure monetary metals like gold don't have. Mining stocks provide leveraged exposure for aggressive investors. When silver rises 10%, quality silver mining stocks often rise 20% or 30% because profit margins expand dramatically. Companies like First Majestic Silver, Hecla Mining, Pan American Silver, and Wheaton Precious Metals offer exposure to silver production with the liquidity and convenience of stock market trading. The trade-off is that mining stocks carry equity risk and don't provide the same protection as physical metal. If you found this valuable, smash that like button and subscribe. Comment with your silver strategy. Until next time, stack physical metal and prepare for the shortage.